All right, it is 6 o'clock. I will get started. We do still have quite a few listeners joining us, but I will start with some of the logistic items that I have to share as they have not shared from call to call. So once again, thank you to everyone for joining us this evening. My name is Marcia Zappa, and I am the Director of Marketing and Business Development at Affiance Financial. I'll be moderating today's conference call. I want to start out by clarifying that this is a call, not a presentation. There are no visuals, so if you are joining by phone, you aren't missing anything. Due to the number of people on the call, all participants have been muted. If you have questions and are joining by computer, please use Zoom's Q&A function. I will be monitoring it during the discussion and will do my best to facilitate live answers to your questions. If we are unable to answer your question during the call, we will follow up to the best of our ability, but also please don't hesitate to reach out to your advisor. Today we have Principal and Financial Planner Andy Fishman, Principal and Financial Planner Steve Lear, Principal and Chief Investment Officer Seth Meisler, and Financial Planner and Co-Chair of the Investment Committee Mark Usum with us. Andy, will you please get us started?
Absolutely, Marcia. Thank you, and welcome everyone. I hope everybody's families are staying healthy and safe as we continue to be challenged in this new environment. Well, this is our 7th conference call over the last 9 weeks. So we had a little bit of extended time over the last couple. And I wanted to just take a minute or a moment here to remind everyone what we've done over that time. We have taken action on our disciplined investment process as we said we would. In March, that meant rebalancing portfolios because the declining market caused portfolios to drift from their asset allocation target levels. As markets declined, we were buying stocks and selling bonds. Rebalancing also included some portfolio changes at the same time. These had been planned during our biannual portfolio review. In April, it meant that we were going to take advantage of selected tax loss harvesting opportunities in energy holdings. Our goal is not to have losses, but when we can take advantage of harvesting tax losses, we want to go ahead and do that. As the situations change, we are prepared to continue to stay focused, patient, and disciplined with our investment process. During our last call, we shared information regarding the CARES Act and the option to waive required minimum distributions from retirement accounts for the 2020 tax year. We have contacted a majority of our clients that are affected by this change to determine what, if any, actions need to be taken. We continue to watch the situations unfold, and we look for opportunities as well as any challenges that may affect all of you. Certainly, if you have questions, reach out to for any of your individual situations. We always remain available and present. And I want to close with one note before I pass it on to Seth. I've had a chance to listen to a poem, and many of you may have also heard and listened to this poem. But if you haven't, I recommend it highly. It's called Hindsight is 2020. It's titled that. And it's also called The Great Realization. You can go on YouTube and you can find this. I recommend that everyone does that. Seth, will you please provide some updated information?
Sure. Thank you, Andy. Before we begin, I'll start with an important disclosure. Please remember that with investing, there can be no assurance that the content made reference to directly or indirectly in this conference call will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that this call serves as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. So now with the updates. April's behind us, and in retrospect, it was a pretty great month. April was up 12.82%. That's the S&P 500, the 500 largest companies in the United States. And that turned out to be the best performing month in the last 33 years, since 1987. Clearly, we're happy with the last month, and it went a long way towards reducing first quarter's losses. We believe the positive market performance is largely due to stimulus by both Federal Reserve and Congress. And there's some more good news. Number one, Federal Reserve stated that they'll start their bond buying program in May. Previously, they had simply announced their intent to buy corporate bonds, which was well received by the market. And now they're actually going to start doing it. The second thing is we're beginning to see some countries open up. Countries that were a couple months ahead of us in terms of COVID-19 infections are beginning to lose their shelter-in-place orders, which is a positive sign and kind of gives us an indication of what to expect in the future. As we've said in the past, we know that there will be another side to this pandemic, and we will get there. That being said, we unfortunately believe that the road to getting to the other side will continue to be a bumpy ride. So while the last month was smooth and up, and in the long term, we believe better days are ahead, we're also realistic that the next several months could be bumpier. Hopefully we're wrong and the ride is smoother. The bottom line is that there are no major changes to our market expectations since we last spoke. While April was nice, we want to stress the importance of thinking long term. We're still long-term investors and believe that successful investing is a result of discipline and focus, as Andy spoke about earlier, and not focusing on short-term movements, whether they are down or up. On a separate note, there have been some regulatory changes that are important to highlight, specifically with regards to the PPP loans for small business. On Thursday night, the IRS released guidance on the PPP loans and stated that companies that use PPP may not also deduct those specific expenses. So you essentially are losing a deduction by accepting the PPP loan. There's been some talk in the last couple of days that this was not Congress's intent, but this means that Congress would need to adjust the law. So stay tuned on that note. And Steve will take us home.
Thank you, Seth. Thank you, Andy, Marcia. Thank you so much for organizing all of these and writing these talking points. And I first want to just express an appreciation to Andy for bringing up, what was the name of that poem?
It is called Hindsight is 2020.
Where can you find it?
I think if you just go on the internet or YouTube and type Hindsight is 2020, you will find the poem.
Okay, I forgot. I mean, I saw it as well. My lovely wife wanted me to see this thing, and it's extremely moving. It actually almost brought me to tears listening to this thing. And I, along with Andy and the rest of the team, urge you to take advantage of that inspiration. I also want to thank the entire Affiance Financial team, all the advisors, all the staff. You have been doing just a wonderful job over these last 2 months, keeping everything moving forward and serving the clients. So thank you very much. So for preparing for a marathon is different than preparing for a sprint. Now, both things are challenging, but each requires a different kind of training, as well as a different perspective. This is Marcia Zappa's notes that she's asked me to articulate to you, and I don't know why she picked me to talk about training for marathons and sprints. But at Affiance, we believe it's time to start shifting our perspective of this pandemic from treating it as a sprint to treating it as a marathon, or at least a half marathon. As things start to open up, we need to be prepared for periodic resurgences of the virus. Please, everybody on this call, do not get this stuff. Do not get COVID-19, please. This includes being prepared for the reinstitution of mitigation measures and the economic results that follow that. We believe it is time to start thinking about life during the pandemic in months and years rather than days and weeks. That in mind, Our next scheduled market volatility conference call will be on the first Tuesday in June. We're going to take, yeah, I don't need to say any more there. We remain ready and available to host calls before then if the situation merits. So please do not hesitate to give any of us a call if there is any concerns. We do not have control over uncertainty, but we do have control how we respond to the uncertainty. And for me personally, one of the biggest things that I've learned is learning how to pivot. If you have questions about your financial plan, where you are at with your goals, or otherwise any other issues, taxes, the investment world, we are here to help. If you know someone that you care about that has similar concerns and seems to be having lots of anxiety about this whole subject matter or lots of concerns about this subject matter, we're here to help. I thank you on behalf of Affiance to all of those on the call for being our clients. I'm going to hand it over to Marcia now, and we will address some of your questions.
All right, thank you, Steve. Steve, a question for you that keeps coming up on these calls is the outlook for the housing market. You recently moved. What was your experience moving during the pandemic, and what is your outlook on the housing market moving forward?
Well, the one conclusion I came to is that I probably overpaid. Sherry and I decided that we were going to move back in the fourth quarter of 2019. We had all sorts of things that occurred. So the closing finally happened like on March 20th or something of that sort. And then we moved a month later. It was very nerve-wracking moving during a time like this, but it was also a great distraction. There's a couple things that go through my head, Marcia, with that question. One, economically, I've stopped thinking of residential housing as an investment. For me, it's always just been, I've never made any money on a residential house. It's always just been a decision of standard of living. So that's one thing that this reinforced in my head, is that it's a question of where do you want to live, what neighborhood you want to live in, what kind of activities do you do. Moving is right virtually at any point in time, as long as it ties in to what you want to be doing with your time over at least a 3 to 7 year time period. It's one of the big reasons why we rented for 3 to 5 years, because we didn't really know exactly where we wanted to live. And we finally figured out where we wanted to live, and that helped us create the clarity to make the move. That's my commentary about residential housing.
Okay, thanks, Steve. Another question that has come up time and again is oil, which has been in the news the last few weeks. Mark, we've talked about it on previous calls, but it still seems to be having a pretty big impact. What are your thoughts on how oil is affecting the markets today?
Thanks, Marcia. I think that's a good question. Oil clearly has been in the headlines as it dropped to record lows, even negative prices that were kind of an anomaly last month. And as we mentioned on a prior call, we expected it to rebound from the lows, and indeed it has, from a price of about $11 to about $25 now. So very significant percentage increase, but still the absolute value is very low. It is a self-correcting market, meaning that as prices drop as low as they have, the producers are going to stop producing oil. They have to. They're losing money on every barrel that comes out of the ground, and they have nowhere to store it. Storage is technically full, and that creates other issues as well. So it is a self-correcting market. The production will stop or slow, and prices will, I believe, continue to rise. OPEC has stepped in. They're trying to reduce output as well, finally. And so I think it will normalize over time. That's the good news from the prospect of the oil industry. And as prices normalize, I don't know exactly where they'll go or when, but clearly it's a unique situation where we have a reduction in demand as well as supply at this point. But I think it will correct, and we will see higher prices, but there will be pain along the way. And we've already seen some bankruptcies from highly levered oil companies. They tend to be highly levered. And I believe we'll continue to see pain in the oil patch, particularly among the producers, but across the oil industry as it takes time to normalize and until the global economy gets back on its feet from this virus. So I think we'll see improvement, and we've seen the market react as oil cratered. It definitely had an impact, a negative impact on the stock market. I think people were concerned about the domino effect and how oil is linked to the debt markets, particularly the financial companies, banks, and such. And I think as we see recovery, it's helped, and we've seen markets recover a bit as oil has, and as we've seen the economies start to open a little bit around the world, and expectations of demand increasing a bit, helping to lift prices as well.
Okay, thank you, Mark. Andy, do you have anything to add about oil?
My only comment about oil has been something that I've consistently said for a long time, and this is more about people's personal pocketbooks and actually companies that use oil. So anybody who uses oil and prices come down, and today they're quite far down because nobody's doing anything, but everyone gets to benefit. It acts like a tax cut. So if you go to the gas station and the price was $3 as an example a year ago, and it's $1.50 or $1.75 today, that's a tax cut. And as companies that use a lot, FedEx, UPS, they actually get to make a little bit more money. So it's just the part about being a tax cut for many of us when prices come down.
Great. Thanks, Andy. Seth, you mentioned the Fed buying bonds in May. Do you have any insight into the quality of those bonds?
Yeah, that's a really good question. And so what's different about their bond buying policy is this time around versus in previous, like 2008, 2009, is back in 2008, 2009, the Fed only bought government and government-backed bonds. So treasuries, mortgage-backed securities, Fannie, Freddie, that kind of stuff. This time, what's really different is that we're seeing the Fed is buying corporate bonds. In addition, they're buying exchange-traded funds, ETFs, that will hold corporate bonds, and they are willing to buy corporate bonds that were investment grade, but that got downgraded due to the COVID-19 shelter-in-place economic shutdown. And so if that happened, they are willing to buy those bonds as well. They have engaged two mutual fund companies, PIMCO and BlackRock, specifically to help them do this purchase of bonds. So it's pretty interesting what they're doing. Other countries have done things like that, particularly Japan is one that comes to mind. So it's not unprecedented outside of the United States, but this is the first time here.
Okay, thanks, Seth. Another question related to the bonds is that the Treasury is preparing to borrow $3 trillion. Where will that money be sourced, and what impact might it have on bond markets?
Well, I think overall this is positive because of the fact that it provides liquidity in the bond market world. In other words, that there is a trading partner. Back in February, March, one of the big problems that we had was that there was literally no buyers for bonds, and just everything seemed to be just locking up. and that got pretty scary, to say the least. And with the Fed coming in and saying that they are willing to be a buyer of bonds, that is, I think, positive for the economic system. And what's happening is that it will be on the Fed's balance sheet. They will be, which again is separate from the U.S. government. I want to be clear about that. And they are able to get money from the Treasury to go out and to buy those bonds. I also want to point out they did something similar back in 2008, 2009, where they lent money to do this bailout, of which a lot of it they got repaid and was profitable on. So it's not such a, I mean, it's not unheard of in terms of the strategy of what they're doing in order to kind of keep the system going.
Okay, thank you, Seth. Mark, we have a question here about Warren Buffett. How much could Warren Buffett's apparent concerns, as indicated in recent news stories, affect the stock market given his notoriety and influence?
Well, I mean, that's kind of an interesting question, because obviously Buffett is in the headlines a lot. And in the Berkshire Hathaway annual meeting was held virtually a few days ago. And so he made more headlines. And the things he talks about tend to reverberate in financial markets, particularly among retail investors. And so there's influence there. The influence tends to be short-lived in terms of headline news. One of the things that he discussed that really made headline news was selling his airline stocks. And so airline stocks definitely took a hit after that news, and then, rebounded as well. So I think that the Buffett news is mostly short term in terms of headline news. The things he says, the things he talks about are, I think, great. And he has excellent investing insights that people can use to invest successfully, including, looking long term in terms of holding periods. His favorite line is he likes to hold things forever, and things like that. And I think, some of the wisdom that he provides is excellent. But in terms of the shorter term trading issues that have come up from time to time, I think it's often hard for people to keep that in context as well. He's made many comments about his mistakes. He's not perfect, and he's admitted to some of those mistakes. And sometimes he sells things. He like he just did with the airline stocks, admitted that he thinks the landscape has changed on a long-term basis going forward, and he's changing his position. And I think those kinds of news items do have some influence. Again, they tend to be pretty short-term in nature, though.
Great. Thank you, Mark. Mark, another question here. Do you have any concerns about the effect of the current geopolitical climate with China on the stock market? All of the headlines we've been seeing about the president and China and the relationship, where that's going.
Well, I do think it's a concern. It's shifted a little bit from the coronavirus and what's happening with that to some recent headlines about tariffs resurfacing and what that might look like. And it's clearly not a great time to start talking about tariffs and protection and other geopolitical issues when the virus is really top and center, or should be, I think, for the global economic community to try to address in a collaborative fashion. Obviously, US and China are, I think, one of Seth's words is frenemies, which I love. And, we have to be friends for certain things, but we're clearly not friends in other places. And so I do think there's a concern that that if that starts to become rhetoric, it could continue to rattle markets. Again, this, I believe, is more of a marginal impact at this point, but it hopefully will take a back seat to more important things like fighting the virus on a global basis. And I think it will also play into the election rhetoric probably in the fall. So it does cause some disturbance, and I could see it continue to possibly raise its head through the fall.
That's great. Thanks, Mark. Seth, do you have anything to add to that?
No, I think the same thing with regards to China is just that it's going to be, we are competitors, and they are a rising economy, and that is going to create some competitive friction. And partly, I think China's also going to be in a wait out mode to see what happens in November. I mean, it's hard to, because of all of COVID, we're forgetting that this is also going to be a big election year, which would be front and center under normal circumstances. So I think it's going to be a wait and see approach, and they're going to try and keep a low profile until to see what happens.
Great. Thanks, Seth. Mark, another question that I think you'll be able to speak to is what industries are showing promise in the short, medium, or long-term views in terms of ethical investment circuits?
Well, that's a great question. I think, again, because it's changing in real time. So we have companies like Microsoft, for example, that are committing to being green on a global basis. And so certainly I think the technology companies to some extent, and it's very interesting too in a way that I think some people don't always understand, that technology companies, especially companies like maybe a Google, that has huge server farms, they use tremendous amounts of electricity. And they've done also a tremendous amount of work on how to generate that efficiently and in a green way as well. So sometimes we don't, we overlook the things that are kind of in front of us as actually being green investments to some extent. To get more specific, clearly, the energy sector, wind energy, even companies like Excel Energy, where 25 to 30% of their energy production is wind energy and continues to grow. And so there's different places. Energy is probably the most difficult because of the mix, because you have some, even the Exxons and BPs of the world that invest heavily in renewables while they're still producing oil because they know that's the future. Specifics, though, go to more probably to some of the pollution control and waste mitigation plays. And in our SAGE portfolio, in our environmentally conscious portfolio, we do have exposure to a mutual fund that invests specifically in some of those companies. I guess it's more of an active participant in those versus a passive one. But looking long term, I think you're going to see it really across companies. I think there's always going to be some quote unquote dirty industries, whether it's in the oil, whether it's in steel production, whether it's in some of the basic mining and things like that you can't really change. So I don't know if that's specific enough, but I think we're seeing it broadly. We're seeing it in some specifics, like the funds that we own, and I think we'll continue to see that grow.
Thanks, Mark. All right, I think we have time for one final question here. Seth, I'm going to direct this to you, but this is not something that I've heard you discuss before. So, hopefully this doesn't come as too much of a surprise. But are you at all concerned about the financial solvency of the state of Minnesota? Is that something that you're prepared to speak on?
Actually, a little bit, yes. So I do want to stress something that's really important, and that is that states cannot declare bankruptcy. So that is something that I've been thinking about. Municipalities can, as we've seen, for example, recently with, not that recent, but happened with Detroit as an example, but states cannot do that. So therefore, in terms of solvency, I would say concern is pretty low. In Minnesota in particular, want to remind everyone that we had a $1 billion surplus that people were wondering what we were going to do with. So I'd say overall, in terms of how states look, Minnesota in particular looks, I would say, pretty good. But just something, again, to keep in mind.
Okay. Thank you very much, Seth. And thank you very much to everyone on the panel and everyone for calling in and listening tonight. We really appreciate it. We are going to wrap up with that. And as Steve Lear said, we will be back in a month, and unless we have a need to be back sooner. But we hope you stay safe and stay well, and we will remain available to talk on an individual level as always. Enjoy the rest of your day.